Okay, welcome back for day two, Master Trader Program Super Performance Workshop. I'm Mark Mינארוויני. I'm here with David Ryan. Dave,
Yes.
I can see Dave got a haircut while he was gone. Uh, all right, so we're gonna move on here, and we're gonna go into some technicals now. We're actually zooming in a bit now and going to that overhead view where we're going to start looking at the current chart pattern within the stage two uptrend and start to look at some of the characteristics that we would look for to ascertain whether it's a constructive price space or consolidation. And we're going to get pretty deep into it now. This is where I look for what is called a volatility contraction pattern, or VCP characteristics. And I'm always looking for these characteristics. I'm going to show you various entry points and various techniques, but all of the price formations that we're going to look at, they're all going to have VCP characteristics. That's pretty much just signature of everything that I do. And Dave will also talk about that as far as what he looks for. And we'll sort of back into getting into the very specific entry points and really honing down and getting to that microscopic view. And then, of course, later on, we're going to talk about risk management, selling, all kinds of other things, IPO bases and power plays. But right now, let's start off with just giving you a description of what we call the contraction count. And this VCP is something that I've coined and termed, and now is a lot of people use this term now. There's a lot of videos on YouTube and so forth about this. Basically, it's just simply the price volatility getting less and less and less from left to right. So from the left side of the chart, you're going to have the most volatility until the bottom. And then when you start running up the right side, you're going to start getting less and less volatility. So it contracts. And generally what happens is you'll have these contractions will happen over 2, 3, sometimes as much as 4 or 5, very rarely 6. And if it goes more than 6 contractions, it's usually abnormal. 7, 8 contractions. I'm not sure if I can remember the last time I've seen that, but we're going to show you a lot of examples. So this is going back, and some of these examples you're going to see over and over, because we're going to show you stage 2 uptrend, and then we're going to show you that same example, stage 2 uptrend with the contraction count, and then we're going to show you that same example with the contraction count and the stage 2 uptrend with the earnings, and then again with the pivot point and the entry point, and even later in selling to show where to sell that stock. Remember, 90% of these, 95% of these are stocks that I actually traded from these points, and again, didn't have the benefit of hindsight. Keep that in mind. So WR Grace was one that I traded right from this point right here when it was coming out on August 26th of 04. You can see I call these T's, or we can call them contractions, C's, T's, whatever you want to call them. I started off calling them T's for tightenings, but we call it the contraction count. And you can see as you come off this first time, you rally, and each contraction is going to be at a higher level. That's how you count them, is that the next contraction will be tighter than the previous, and it will be at a higher level. So you start getting that ascending or higher lows moving up from the low and the base. And then you get to that right side, and that's when we start getting interested. Dave, when you're screening, what do you, because some people say, how do you go through? They see a screen, we go through pretty quickly. How are you going through so quickly? What are you looking at when you're going through the screening?
I'm basically looking at really the last few weeks of price action. And I mean, I can see, more than the last few weeks, but I'm really honing in on really last few weeks, last few months, and I'm looking for this all the time. And that's why I can go through hundreds of stocks in just a few hours, because that's what I'm really zeroing in on. And if I find that, then I start spending more time with the name and looking at the rest of the formation, looking at the earnings and fundamentals and things like that. But it first starts with that just a 1-second glance if I'm going to do any more work into it. And a lot of times I can eliminate hundreds of stocks within a few seconds because they just don't have this pattern.
That lack of volatility on the right side, if you don't see that, then you're not even considering it, right?
Right. And the other thing I would just add to this is that if I own a stock and I see a lot of volatility, that's actually a very big negative for me. And to me, that signifies what could be a top. Especially if a stock has had a long run and then it's just doing this back and forth, to me, that's negative. But when you get a tightening pattern, this VCP, that is very, very positive.
So let's give you some specifics here. How tight is tight? And what we like to see on that right side is that tight part of the pattern to be in single digit percentages. And the reason why is because we don't want our risk to be much more than 8% or so. Sometimes if I'm staggering stops, we'll talk about staggered stops and bracketed stops later on. But if I'm using multiple stops and I'm going to use an average, I might have one at 4%, and I could put the other one at 10 because now my average will be 14%. My average will be 7%, right? 14% divided by 2. So I might go a little bit more than that single digit, but not much more. Right around 8% is going to be sort of my maximum stop, and Dave's too. And the reason why is because, and we're going to get into this in risk management, but the math starts working against you. So we want to keep those single digit losses under control. So we want to be able to know when the stock's acting abnormal. So if the stock starts engulfing that right side and there's volatility, well, then that volatility is not going to be too wide where we're going to have to wait for the stock to go down 15 or 20% before we could conclude that it's not acting normal. Just remember, if you know what's normal and you know what's abnormal, you're going to know when to be involved in the stock, and you're going to know when to exit the stock. And we're going to get into that in quite a bit, abnormal versus normal. So just take a look here. Let's go back and just get you up to speed with the VCP. You can see the first decline is 29% from peak to trough. Then it rallies back and it comes off 9%, which right there, that's pretty tight. But this even tightens up even more and really gets tight. And that last little pullback is only 3%. That is perfect. I'm licking my chops now when I see a stock like this, because that lack of volatility is telling me a few things. One, I've got a really nice low risk entry point, and number two, that there's no supply coming to market. We're gonna talk about that in just a minute, about supply coming to market and the line of least resistance. Remember that. Keep that in mind. Okay, take a note of that. The line of least resistance and supply not coming to market. So here's FSI International. This is a stock that I bought back in 95. 95 happened to be one of my biggest years ever. I was up over 400% that year. It was a game-changing year for me. And this was a stock that I bought that made a nice, big, quick move coming out of this. And this is just a classic cup with handle. Keep in mind, VCP, volatility contraction pattern, is a characteristic. It's not. It is a pattern, but it is a characteristic also of many patterns. So again, here you come down 18%, and that right side, just a 5% pullback. This is a weekly chart. You're going to see this on a weekly, and you're going to see it on a daily. Let me show you the daily. Take a look at this. Look how tight that is. You see how it just gets really, really tight here? So now you go through this volatility, and then the volatility contracts. I'm buying it right here as it comes out. And then you make this nice move, and this was a pretty big mover.
And Mark, let me just add, is that the tighter the pattern, the lower your risk in terms, or the smaller your risk, because if that stock, let's say it breaks up and out of that pattern, but then quickly reverses and goes back below that really tight formation, then that's not right. That's a stock that's breaking out and could be failing. And you know exactly where you can sell. You sell right underneath when that pattern is broken, and you don't have to wait for the 8%. I mean, that's probably going to be a lot less than 8% if it drops below that tight area.
Yeah, and this was very tight, so you had a very low risk. Another thing, too, I'm going to jump ahead here for just a second. Usually it's Dave that jumps ahead, and I got to slow him down, but I'm going to jump ahead for just a second. Dave, taking a look at this breakout, and we're going to get into what's normal and abnormal violations and confirmations, but this stock is really confirming quite nicely. 1, 2, 3, 4, it looks like 6 straight days up, and then a brief pullback and right back into new high ground. That's what we call tennis ball action from a natural reaction. This is a really, really nice breakout that's showing the confirmation, and you're never under any pressure. The key is that when you time them right, you should be under no pressure. And this is something that I heard Dave say 30 years ago when I went to go see him at a seminar. And also, I think you might even said it in Market Wizards. The best thing, Dave, that you said that can happen when you buy a stock is that you're a profit right away. And can you explain about that a little bit?
Well, if you're buying a stock correctly, and I anticipate every time I'm buying, I'm anticipating that I'm going to be up almost immediately. And because that's when I'm buying, hopefully my timing is exactly right when the stock is coming out of a pattern like that. And then I can go ahead and add to it. But if the stock doesn't get going and starts just messing around and doesn't follow through, then I know that there's something wrong with the stock or something wrong with my timing. The other thing I think is important to look at on this is look at the volume down below. As that stock tightens up, the volume absolutely dries up. It looks like 1 day out of 2 weeks was average daily volume. But look at the volume on the two sides around it as it was coming up into that tightening pattern, and as it was leaving the tightening pattern. Look at the volume. That's the big institutional buying that you want to see when a stock is going into an uptrend.
So again, let's talk about that real quick. When you have the contractions and you're going through this volatility contraction, you want to see volume also contract. As Dave says very often, you can sometimes watch the volume and see the pattern of the stock actually in the volume. So let's take a look at another example. Here's USG. This is one that I actually did trade this. It doesn't say I bought here. It doesn't say I bought here, but it does say buy point. I actually bought this breaking out of this pattern. Another stock that was just so tight that it was just, I had to buy this because the risk was so, even if I let this come all the way down and take out these lows in the second tightening, it would have still only been about 7% loss. And that's within my maximum 8% stop loss. The first decline you can see is 20%, rallies. Second decline is 7%. And then that last tight area is just 2%. Very, very tight. And again, like I said before, everything builds on previous. So you see, we're already in a stage 2 uptrend. So now we're in the stage 2 uptrend. Now we're looking for the volatility contraction. Let's take a look at another one here. Now, remember I said you can go through a number of contractions. You can go through anywhere between 2, and even you can even have no contraction if it's so tight and you're in a flat base, or sometimes in a power play, which we'll talk about later. If it's just 10%. From peak to trough, it could actually be just, and that wouldn't be a volatility contraction. That would just be a very tight pattern. But generally speaking, you're going to see 95% of all your setups are going to have at least one tightening, which would be a 1 and a 2. But many of them are going to have 3 or 4, and you're going to even see 5 and 6 at times. So right here, you see from peak to trough, come all the way back down here, you rally back up and you pull back again. And then you rally, you pull back again. And then look at that last tightening. See how tight it is? Really, really small fluctuation. And then you come out of there. You spend just 1 day pulling back, or 2 days. And then whammo, you're off to the races. So 1, 2, 3, 4. The other thing too, and Dave, we talk about this. We're going to definitely talk about this later, but we might as well get into it a little bit now too. I drew a line here right, so we can explain how we want this action to set up at what Livermore called the line of least resistance. And you'll find that these set up in an area where the majority of the price action trades below where the pivot is. And Dave's going to expound upon that a little bit. But again, Dave always says, just draw a line. This started back in, like, I think it was the first or second Master Trader Program day that we did live, and someone kept asking questions and questions and questions about resistance and support, and finally Dave I think he got frustrated and just said, man, just draw a line. And ever since then, I've been saying, just draw a line, man, just draw a line. So
because so many people, they're looking for cups and handles, double bases, or double bottoms and triple bottoms and all these saucer shapes. But what you want to find is where the majority of the highs on the stock form. And you can see, right where that line is drawn. You do not have to wait for the new high for this to buy the stock. But I'm saying where a majority of those highs are built. And it looks like it looks like 90% of that trading is done under, looks like 16 and a half. So when it breaks 16 and a half, that's where you can buy the stock. And you just draw those lines. You don't have to, you want to see the contraction going on, but you don't have to be looking for cups and handles all the time. They actually don't exist. They don't happen that often. Cups and handles occur when you go through a correction. And if the market's not correcting so much, you're not going to see a cup and handle. You see other just flat bases. So that's why I say just draw the line. It makes it so much simpler than looking for all these patterns.
Yeah, and we're going to tell you there's a really good reason behind this and why these stocks set up in this manner and why these buy points are where they are. They're not just, some people think they're just because guys like us or so many people before us this talk about this, that it is a self-fulfilling prophecy. It's not the cause, it's the effect. And I'm going to get into that in a little while, and I think it'll be mind-blowing for you. But the key is here. Let me give you a few small tips here, if you will. The key is that as you get further and further away from the right side and the pivot point, you can have more trading above that price point. And the closer you get, the less trading that you want above that point. So, and this is where we call it overhead supply. And again, we're gonna get into this. I'm actually going ahead myself here. But the key is that you can see right here. You see how there's only 1 day, 2 days where it trades above that point just briefly, and it closes one day, the other day it can't, and then you just have a little bit of trading on this left side. So this becomes the key area where you've got supply. This is where there's supply, there's stock available, and this is why the stock keeps bumping at that area. When you get to the right side and you start quieting down and the volume comes down, what that tells you is supply has stopped coming to market. It gives you an indication that supply stopped coming to market. Now, if this is a stock that's in an uptrend and we've done our homework right and institutions are indeed interested in this, well, if supply stopped coming to market and there's an appetite, there's demand for the stock, what does that mean? That means that it could be very explosive. And that's why they explode out of these points, because when you get low supply, it's just simply supply and demand. When you get low supply, big demand, prices move very rapidly and move quite a bit. Here's another one. Take a look. See how this price explodes out of here? This is not because everybody's watching a cup with handle or because the big guys are using this or there's some conspiracy. This is simply the law of supply and demand. And as you go through this, here's your first decline, 2, 3, 4, 5. You might even be able to call this 3. But if this one's a little bit bigger than this, then we would call this 3. So again, not real important to be perfect on this. The key, and as Dave said, is forget about all these terms and semantics. Are we contracting? Are we getting that tightness on the right side and a nice low risk entry point? And draw that line and just see where the majority of that price is forming. And when you come through that point, that's where the real excitement starts. And you see how this explodes here? That's because we've quieted way down and volume has come down, prices come down, supply stopped coming to market. Okay, so now I want to tell you, explain this to you. So let's talk about supply, overhead supply, and about supply not coming to market. Because this is something that no matter how many times I say it, sometimes a lot of people don't really understand. What does that mean? Supply not coming to market. So let's just think of it this way. So here's a stock chart, right? Call this whatever price you want to call it, $100, and we can even call this, let's say, $50 or $60 down here. So there's always going to be someone in the stock, right? There's trading in the stock every day. So there's some buyers that buy in this area right here, and they may even be buying this as it comes back and pulls back, whether they're value buyers or someone who was, just got a tip on the stock. Now, as the stock comes down, these people are at a loss. Right? They're underwater. Now, somewhere along the line, the stock bottoms and starts turning back up off the lows, and you're going to inevitably have some people who bought around the lows. So now as you come back up that right side, you have two types of supply. You have trapped buyers, people who are stuck in the stock at a loss, and you have buyers that are at a profit. So as they start coming up, as the stock starts coming up the right side, the profit takers are taking some profits, and the trapped buyers are getting closer and closer to break even. So they start also selling and taking their losses, maybe smaller, or when it gets back to break even, you've got a lot of people that were unhappy for a while, and now they're happy to get even. So as this takes place, it pulls the stock back, and you form that next contraction. And now that whole cycle starts all over again. Now you've got some people that bought it this high, and as it pulls back, let's say 10%, you've got some people who bought it at the lows. Although there's going to be less volume here because it's happening for a shorter period of time, and it's not as deep. So the trapped buyers aren't going to be as trapped, if you will, and the profit takers aren't going to have as much profit. But there will be shorter term players in here. So now that's going to cause, as it comes back up the right side, same thing. Trapped buyers are getting even. Profit takers are having profits. So now they sell and they create the next contraction until you finally get where everybody's pretty much gone and you don't have any supply left in the stock. So think of it like this. Did you ever take a towel and it's soaked with water? You take a towel, put it in water, pull it out. It's real heavy, right? Because it's holding all that water. You take it and you twist it and twist it and twist it as tight as you can and wring all the water out. Right? There's no more water comes out. You untwist it and you retwist it again, and more water comes out. Right? Think of that as one of the tightenings. So now you undo it again, and now you squeeze it again, and even a little more water comes out, but less than the last time. And each time you undo it and retighten it, less and less water, but water keeps coming out. It's almost like a magic trick where you thought all the water was gone, but it wasn't. You had to actually unravel it and then bring it. Think of the unraveling as the pullback. Now, as it comes back up the right side, that's the tightening again. And now a little more water comes out until you squeeze it 4 or 5 times and you can't get any more water out of it, even when you unravel it. That's exactly what happens with the stock going through a contraction. As it's going through these contractions and you're going through trapped buyers and profit takers, trapped buyers, profit takers, trapped buyers, profit takers, it gets smaller and smaller, and the supply is diminishing and diminishing. Now, when it gets to the right side and there's no more supply, you've got very tight price action and volume comes way down. That's good. That's exactly what you want to see. That means the stock is now vulnerable to being able to move very, very rapidly. And when buyers come in, the stock explodes. Let's take a look at another example. You'll see, and you can go back and look at the Amazons, Googles, Netflix, all the FANG stocks. You can go all the way back to the 1800s. We've studied stocks all the way to the 1800s, 1920s, 30s, Coca-Cola, GE, whatever you want to, the rail stocks back then. They're the same exact thing because this is timeless. This is not going to change. It's been the same since the beginning of the stock market. It's going to be the same 100 years from now because this is the law of supply and demand. It's just all about timing. So as Dave was talking about how look at the volume, you want to see the volume come in and then the volume starts to expand as you break out. I bought Netflix right here. This is in October of 2009. After you had a nice base here, here's your consolidation, your VCP, 27%, right? That's too volatile, not buying it there. Goes to this back and forth action, 17%. That's too volatile, not buying it there. Now it comes back up. Now, as Dave said, he's looking at those charts. When he sees that right side, that's what he's keying in on, that right side. When he sees the tightness on the right side, then he goes back and takes a look at the whole formation, maybe takes a look at the stock. Is it in a stage 2 uptrend? Does it have the earnings, the sales, the margins, all the things we're going to look for? And now we know because it doesn't matter. We're not going to look at the stock unless the stock is in a tight buy point on the right side because we're trying to time the trade at the exact right moment.
The other thing I would like to add too is that, and you might have mentioned, I mean, this hasn't changed. As a famous book says, there's nothing new under the sun. The other thing too is that we're looking at, I guess, a daily time frame, but you could go down to an hourly time frame, a 15-minute, a 10-minute, a 5, even a tick chart, and you're going to see these same patterns over and over again.
Right. It doesn't know any time frame. It's because it's the law of supply and demand. Yeah. It's simply the law of supply and demand. And we're going to show you a bunch of examples here. Let's take a look at Square. So, and right now, I want you to key in mostly on just understanding the volatility contraction, right? I'm just showing you examples to go through the volatility contraction and show you what we're looking for on that right side and how to count these contractions. We're on the contraction count. We're going to add in the volume and we're going to show you every little nuance right down to microscopic. But remember, we're on an overhead view right now, right? Maybe even an aerial view. We went from a satellite down to an aerial. Now we're kind of going overhead. So we're going to zoom in, and we're going to zoom in really, really tight really soon here. But take a look how you go through the pullback. 13%, 5%, 3%. This is a really, really tight stock to begin with. So again, I would love this price action. And this is one that you actually had 2 buy points. You had a buy point right here at 5% because that was tight enough. 5% was tight enough. But then the stock actually pulled back again. And within that basing, you got another buy point. And this happens very often. We'll talk about multiple buy points a little later. So take a look at this chart because this is really interesting. Look how tight we get on the right side here. Look at the volume. You see how the volume comes way, way down? So this is a quintessential VCP where you go through and you get tighter and tighter until you get so tight and the volume comes away. And that tells you that supply is really, really diminished and it's not coming to market anymore. And now, boom, you break out of there and now you're off to the races, right? So guess what? This chart right here, this is a intraday chart. These are, I believe, 1 minute or 5 minute bars. And let me show you where this all exists. All this price action, all these bars is from that point to that point within this one daily bar. So the reason why I'm showing this is not to say that you're to tell you to do this in day trade, although you could. We have lots of people that have taken these techniques and use them for day trading. You could, but to show you that it's completely timeless. This is the law of supply demand. These dynamics. It doesn't matter weekly chart, daily chart, intraday chart, 1 minute, 5 minute, 15, 60 minute. Doesn't matter. You're going to get the same type of action. And if you learn to time these properly, you'll understand the law of supply and demand. You'll understand the dynamics. Now, what I do is, and I've come up with this sort of template, if you will, where it's twofold. One, it's when I look at a stock, I'm sort of just overlaying this template. I want to see these contractions. So I'm looking for what I call the VCP footprint. And what this does, this actually, once you go through these contractions, I actually put a little acronym, if you will, or a little code. I'll put, and this was just, when I keep my notes by hand on my notebook, just so I can look at a stock and look at it on my notes and see the symbol. So I got X, Y, Z, as a potential candidate. I can see 40W, 31 by 3, 4T. That means 40-week base, largest contraction or largest pullbacks, 31%, 3% on the right, and it's gone through 4 contractions. So I get a picture, I get a mental picture of that in my head. Now, you don't have to write this down, but this is what you want to get familiar with, are these 3 aspects of the contraction, of the volatility contraction. And think of it like this. Like if I were to tell you, hey, do you know that guy Joe? And you say, who's Joe? Oh, he's that big guy. He's like 6'5", 284 pounds. He's got like a 46-inch waist, 55-inch chest. And I start giving you these dimensions. You wouldn't know what Joe looks like, but you'd have a pretty good idea of his build and his silhouette. So that's what I try to get. That's what I'm trying to get in my mind of what the silhouette is. And then the silhouette of a winning stock, you start burning into your mind of the stocks, that how they set up and what that silhouette looks like. And then you start overlaying that on your potential buys. And that's where you'll start to see this and really be able to see this in real time. So here's Netflix. This is on a weekly chart. So see, again, you're going to see the exact same thing, 27, 17, 8, and now it's ready. And now you're ready to buy it as it starts to turn up from there. 27 week, 27 by 8, 3T, 3 contractions, or 3C if you want to call it. But again, see, I can get an idea of what that pattern looks like just by having those little notes in my head. Okay, let's take a look at a few other, and I want to show you this too. I know I'm jumping around here, and you've got the workbook pages. We're going to actually jump over this page and just go to 143. So think of it as putting on a pair of glasses, and on those glasses, you've got this template. And then when you look at a chart, it overlays it. You want to back into that template. You want your stocks to look like a certain, and Dave, you say this all the time. Dave and I used to talk quite a bit, during the trading week. And I would say, hey, what do you think of, Netflix here? And he'd say, it doesn't have the look. That was his way of, just telling me, nope, it just doesn't have that look, what it's supposed to look like technically. So, we're not interested until it's got the look. And that look is this is having the look.
And how you get that picture of what these stocks should look like right before they make their move is you study the greatest winners. You study the stocks. You can even use it, you can, any charting program, if you can go back in time, or even look at a chart that's made a great move this year, go back to where it started the move, and you'll see these VCP patterns all the way, as it's right before it starts its move, and then it bases again, you'll see these again. But you've got to get that picture in your mind of what this looks like. So when you're going through charts, you'll be able to say, hey, that's got that look that it's about to go.
Yeah, and that's what we're trying to do here. We're trying to give you not only show you all these examples, but give you the understanding behind it. So you understand what's happening, and you can really then visualize what you need to see and have some imagination as you're going through this, because you have to do this in real time. This is in hindsight, we look at all these stocks and you go, oh yeah, that looks obvious. Yeah, right there. There's where you buy. Yeah, because you're seeing it afterwards go up. But in real time, you've got to make these decisions in real time. And it's much more challenging, believe me. And you're going to have to do a lot of post analysis, and you're going to make a lot of mistakes. But eventually you'll get to the point where your eyes will have these built-in VCP template glasses. Now, keep in mind, this isn't our creation. Okay. This is an observation. This is something that we've observed and learned, that these are timeless principles that go all the way back to the beginning of time. They're just the footprints of supply demand. It doesn't work because we use it or because someone with more money is manipulating the market. It works because this is the effect. This is the effect, not the cause. Very important point to always keep in your mind. All right. So again, stage 2 uptrend. Where are we looking for these? We're looking for these as soon as the stock gets into a stage 2 uptrend. So right away, when it turns into that stage 2 uptrend, you're going to start looking for VCP action. Okay, as soon as it meets that criteria. And Dave, you said that you like to use my 1 month template in MarketSmith, and that's one of the screens that can get you into these VCPs as early as possible, right? In these stage 2 uptrends.
Yeah, and especially turnaround stocks that haven't done well for a while, or they've just in one long base. That 200-day moving average starts turning up as the first little move occurs. So the stock goes from 10 to 15. But then tightens up, and that 200-day has moved up, and that's probably about the earliest buy point that you can get of a stock that is just coming out of a long basing period.
Right, and Dave, as you said before, we don't have to necessarily get the very first VCP in a new uptrend, right?
No, you can. Yeah, you can. Look at how many are in this one. You've got a number of chances to go ahead and buy the stock, and if you don't get the first base, you get it at the second, or you get it at the third. And some of them, usually a stock makes a move over a year or a couple of years. So you'll have a chance to find another spot where it does this.
Yeah. And often too, believe it or not, the later, as you get very late stage, sometimes you get blow-ups and they're very quick and you want to sell into those. But sometimes the middle of the move gives you the most momentum. So being early, some people think, buying low is better. Not necessarily. If you buy, again, like we talked about before, you don't want to buy at the lowest price. You want to buy at the right price. The right price is buying just before the stock's going to move and move dramatically and quickly in your direction. That's the right price, because time, like we said before, time is also very important, time value. So let's look at some more of these. We're going to go through some more examples, and then we're going to show you, we're going to dig in a little bit deeper and really start to hone in on more specific characteristics. There's a lot of, think of it like a fingerprint. If you look at a fingerprint from far away, they all look alike, but no fingerprint is the same. It's the same thing with a stock chart, although there are characteristics within the chart that are going to show up every time. Every time you're going to see these certain characteristics, and there's only a handful of ways that you're going to set up within this VCP. So we're going to show you the various ways that the stock can set up, and you're going to have sort of this toolbox and have various levels to be able to get on a stock as it's starting to move. Again, looking at this BIIB, of course, it's Biogen, made almost a 500% move in 41 months. 1, 2, 3, 4, and then really tight right here. And see, once again, you see how once it comes out of here, look at how quick. Look how quick it jumps out in those first 4 days. 1, 2, and then 3 and 4, boom, comes ripping out of there. Barely pulls back, gets right back at the new high ground. That's because supply stopped coming to market, and now the stock is at the line of least resistance. Now, one of the things that we got to caution you with, and I've noticed in this recent last cycle, we have had a lot of stocks that have had pretty big declines, and some have worked. But generally speaking, when a stock is down big in that first cup with you, if you will, with a cup with handle, or in the first pullback of this volatility contraction pattern, if that is excessive, and excessive to me is when it gets over 50%. Yeah, I usually scratch it right off, and I don't even look at the stock, because now what happens is, and there's another way we're gonna measure that too. It's against the market, but just looking at in absolute terms, a stock that's off 60% now, comes back up that right side and has to make a really big move. You have three problems. One is that the big giant decline right there tells you that something may be wrong with the stock, because why is it falling so much? That's number one. Number two, you've got a lot of trapped buyers. So you have a lot of overhead supply to contend with as it comes back up the right side. And you also have, as you have buyers around the lows, as it makes that big move, you've now got a lot of big profits that are going to get sold into. So your overhead supply increases dramatically, and that's why you'll get, very often these will fail. They'll come back up, they'll set up, and they're faulty setups. They're too wide, they're too loose, and they'll suck you in, and then they'll just collapse very quickly. They get overwhelmed by that supply. Dave, are you, when you start getting 60% declines in the stock in the correction phase, are you even considering those?
No, because the stock then has to more than double to get back to new highs. And the other thing is, my rule has always been, once a big stock has declined 50%, it's usually going to take a number of years for it to reset itself. And usually once a stock has had that big of a decline, I almost stop looking at it, because I just know it's going to take too much energy to get back up to the highs, and it's probably going to fail. The only time I have seen this where a stock would decline more than 50% and then come back up to new highs and break out is in years of tremendous amount of speculation. And to me, that happens about every 20 years. That was in the year 2000, 1999 into March of 2000. And then happened again in 2020, where some stocks had huge declines. But it's very, very rare that they do that. And that's why you're better off, once they've made that big of a decline, to just kind of keep it on the back burner, maybe check it every few weeks or every month. But it's not going to be a leader again.
Right. And also, like Dave said, this is also looking at the market and the environment. If you have a big bear market, you're going to have bigger and deeper bases. So they're going to be somewhat of a function, but you should always compare it to the market. So if you can see right here, I point out that this decline is a 60% decline. This is abnormal weakness because the NASDAQ during this period only went down 6% during that period. So this is way underperforming. That tells you right there, there's tremendous amount of selling going on, and there's probably something wrong. Here's another stock to take a look at. This was a Travel Zoo, which comes off here. And again, 50% correction, while the NASDAQ is only down 10%. It did have a correction, but stocks that correct 5 times the general market, right there, that's telling you that something's wrong. Now it comes up the right side. It sets up. It does contract, breaks out, but then look at this. Pow, it fails, gets on a big gap, comes crashing down, and that's because it gets overwhelmed again by that supply. Here's one that I had so many people ask me about this setup here on the right side, and I just kept poo-pooing it, and for some reason a lot of investors were interested in GoPro after it made this big decline. It was down 61% with the NASDAQ up only actually, the NASDAQ was up during that period. It wasn't even down. So when I talk about an underperformance, 71% underperformance. Now, it did, if you were so clairvoyant to buy the absolute low, it did make a move here. But by the time it got into a stage 2 uptrend, this now had such a large decline and was coming back into a lot of overhead supply here on the left side that wasn't too far back. If this was 5 years back, well, then that would be okay. But being so close, just a number of months, now you've still got a lot of overhead supply, and that set up in a very strange fashion and then just came right off and sold off. You'll see this will happen also in late stage environments where you've got a stock that broke out and maybe it came off of a bear market. It's set up. This is Decker's Outdoors. I actually was buying this coming out of this base right here, and you got a few smaller flat bases. You got another base here, and now you're getting into those late stage, 4th, 5th, 6th stage bases, and they get wide and they start undercutting the 200-day. Again, you're going to get those very deep cups, and those are going to be wide, loose, and prone to failure.
And that's almost a 50% drop there. I mean, 55 to 30, it got close, but it's still deeper than what you'd like to see. Also, the other thing is keep an eye on the time frame. How long has this thing been going? And this stock has been moving for a couple of years. So you combine the gain in price with the time that it's been running, and usually that clock is getting late after it's been running for over a year and a half to 2 years. It's time to be looking for a top.
Right. Okay, so now we're going to actually zoom in a little bit more now. Okay, we're gonna come in and zoom up and really take a look at that right side. So this is what we call the pivot point. And a pivot point is simply just a tight area or a price formation on the right side that is an actionable price. When you get through the high of that price point, that's where you're going to be placing your buy order. Now, there's a lot of ways that these pivots can line up and can set up on the right side. We're going to show you the few ways that we use them, and if you use the pivot points from these various levels up the right side of the base, you're not gonna miss too many stocks that set up and move out as market leaders. They're gonna give you enough entry point techniques to be able to get on these stocks at some point. So the thing you got to realize that a pivot point sometimes will set up where all the price action sort of aligns across to that pivot point, and then other times it's going to set up a bit lower. And I'm going to show you these two types of setups here. But let's start off with just looking at a very straightforward, simple setup where basically all the price action is lining up right across, and the breakout is going into or very close to new highs or even all-time highs, 52-week highs. And sometimes they're not going to be that close to all-time high or 52-week high. It's going to be off the high, which we'll look at next. So right here, looking at AMSC, American Superconductor, you can see here, big move too, over 200% in just 13 months. Here's the contractions: 1, 2, 3, gets real tight on that right side, and then bang. And look at how the very next day, you'd be buying it right here. And then the very next day, look at the volume and look at the explosion that comes out of here. Again, that's where supply stopped coming to market. And now the stock is very, very vulnerable to moving very quickly in a direction once that supply comes in. I'm sorry, that buying comes in with a lack of supply. So again, looking at CBPO, right? This is another stock that, and again, looking for super performance. I know we're going to look at a lot of charts here, and many of these you'll see went up 500, 1,000%, 8,000%. Super performance is also quick moves, very fast. I mean, if a stock goes up 80%, 60, 70% in a number of weeks or a couple months, that is a big move, and that can really, really make a difference on your portfolio. You don't have to get a stock that goes up 500% to make big returns. If you're compounding these and you're getting stocks that are moving even 25, 30, 35% in just a number of days or weeks, you could be turning this over and getting a huge return. So again, I want you to look at how the stock, once it comes out of this base, just moving sideways and going through these contractions, look how it explodes and comes out, and it's so efficient coming out of there, right? That's the lack of supply. The lack of supply sets that up. And what you're trying to do is time that trade perfectly, right? That's what specific entry point analysis is. Coming to that very, very specific day, right down to the day, and really zooming in here to get that buy point perfect. All right,
and Mark, the interesting thing is that China biologic products looks so similar to the one before this.
Oh,
I mean, they're almost the exact. I mean, that's almost the exact same chart. And so that's why we keep on saying these patterns repeat themselves over and over again.
You will see. So again, you will see so many look like they're the same chart. And again, like a fingerprint, you look at it and it looks the same, and these will look the same, but they're going to have a lot of little nuances in there. And we're going to get even deeper, and we're going to show you. You'll be surprised at how many little things are in there. It took me a lot of years to get these eyes where I can really see all the little characteristics. Dave is just phenomenal with dissecting volume and seeing things that most people just don't pick up. And we're going to go over all that here. And again, looking at these charts, history repeats. These repeat over and over. This is not something where we've come and said, hey, we're gonna let's go find the charts that make our point. Nope, these are all the trades that I've made. These are going back and looking at the stocks that made the big gains, the big fast moves, and stocks that I traded based on on these characteristics. 95% of these are all trades that I made in real time on this day, buying right here, without the benefit of hindsight. And again, that's what you got to get good at. So again, here we go. Here's the pivot setting up. Now, you see the pivot point here is below this high here. That's okay. But here's sort of the general rule of thumb. If you have, so this is a big question that I get all the time. Okay, this pivot, this last tightening takes place, but the high right here, okay, is a little bit higher. Maybe it's 20 cents higher. Do we buy when it comes through here or when it comes through here? Well, the answer is you can do both. You can buy a little as it starts to move through the pivot, and then when it clears, what we call this the turn, when it makes the turn and gets to that high point right there, you can buy some more. Or if it's so close, you probably just want to wait until it gets through this price right here and get a little more confirmation, because it's not really costing you much. If it's costing you 10 cents or 20 cents, wait for the confirmation. But sometimes these pivot points are a good distance below. And by the time it even gets up to that point, you're already at a decent profit. In this particular instance, it's really, really close. Here's a stock I bought back. This was Baby Stores. Some of you that are older and may remember this. This is going back also, into the 90s here, 1998. This is really a perfect IPO base where you set up here and you go through that first base after an IPO, and you can see as we draw a line right through here, you see how the majority of the price action, and the closer we get to the right side, the more this confluence area becomes sort of a very, very specific price point that's very close. And you can see the pivot just a little bit lower than this price right here. So you can wait for it to clear that. As you get over here, even here, there's only a couple days where it trades above. And as you get further away, you may get more days to trade above. But as you get closer to the pivot, now you really start to tighten up, and that price point becomes the area that you're looking to move through. I'm going to show you example after example here. So here's right here where we just looked at, and then you got another opportunity here, and then you got another opportunity here and here. So you've gotten all these opportunities in this stock. So again, if you miss this buy point, you got more buy points to take advantage of. Here's something more recently, McAfee setup. You can see right here. See how the pivot's here, but then you've got the turn right here. And again, if you don't know these terminology, don't worry. We're gonna get into it more, and we're gonna show you, and everything's gonna be explained. We're not gonna leave anything unexplained. So again, right here, this pivot right here, as it's moving, you'd be buying it as it comes right through this area right here, and you've got the contractions 1, 2, 3. Take a look at here. Here's EDU. I bought this stock coming out right here. And this is really just absolutely as perfect as it can get. Just super tight right here, tightens up. Now, let's talk about volume a little bit. You see how the volume comes way down here and then it expands. This is what I call the 1-2 punch, where you contract in the pivot and then you expand on the breakout. This is what you want to see. And you want to see the contraction actually in most of the tightenings. And the tightening, the areas where the stock is going tight, you want to see the volume come in. And then when it's moving up the right side, that's where you want to see some volume. But particularly when it's in the pivot, that's where you want to see the lowest volume that you can possibly get. And this really throws people for a loop sometimes. I'll put a stock on our service, or I'll be buying a stock, maybe talk about it in Twitter, and those people say, "Oh, that stock is trading, 20,000 shares a day." Yes, but it normally trades 600,000, and now in the pivot point, it's come way down, and the stock is trading very little. That's opportunity. All right, that's not something to be afraid of. That's exactly what you want to see. That's saying that stock has stopped coming to market, supply has stopped coming to market. Now, Dave, you just said, some of these stocks look exactly alike. Look at these two. Here's new education, New Oriental Education, 2007, up over 100% in 7 months from here. Here's how do you pronounce this? Meli, MELI. Also in 2007. Look at this, the perfect price setup. And same, here it is. Here's the 1-2 punch. Look at that day right there where I have one. That's right in the pivot at the last day, just before it takes off. You see how it's just about the lowest volume in the entire move. And then the volume comes in. There's your 1-2 as it comes out of the pivot. And there's your VCP.
Yeah. And the information on these stocks are exactly the same. Most of them have, very, very strong quarterly earnings and annual earnings and all the CAN-SLIM characteristics, and they have similar patterns. The only thing that really changes is the name on top of the information. Everything else is basically the same over and over again.
And look right here, 75% in 13 days. See, that's a super performance move. I'd actually rather have, if you could give me these stocks all day long, I'd take these before the big giant multi-year movers, even, the really big movers, because if I could compound 50, 75, 100% every couple of weeks, or even every month or two, oh boy, what a return that you can rack up. Look at the contrast in volume here. You see the volume in the base, right? And then when the stock gets going, see all the volume coming in here? That's the institutions coming back into the name. And that's precisely what you want to see. That's where all the excitement happens. It happens after it comes out of the consolidation and moves out and is in new high ground. Remember, we talked about new high ground? If you're going to make a big move, the stock's going to be having to make new highs. 81% in 38 days. Here's American Superconductor. Goes through the contractions. This is really just textbook, picture perfect, 60% in 17 days. So now we're getting into some of the very quick moves here, that stocks that went up in just a couple weeks or a couple months. But again, all the same characteristics. Here's the 1-2. Look at, you could barely even see the volume. It's almost non-existent. And then boom, you come back in here. All right, let's look at another one. Again, look at these two. They look almost identical. They look almost identical. You get the same type of action here. You tighten up on the right side. You get that last tightening. There's the 1-2, right? Contraction, expansion, comes out, and a nice efficient move to the upside there. Netflix, we talked about that before. Same thing, 1-2. Here's Shopify, 2018. Very similar. Contraction, coming in, getting very tight. Here's your fourth contraction, and it tightens up. Look, the volume comes way down, and then wham, look at the volume coming in. Big institutional volume coming in, breaking this out. No wonder it turned out to be a big winning stock. But in this first 8 months, it was up 175%. Quest Communications, this was 98. This is one that I bought. I remember this one well. Tightening up on the right side, and then gets really, really tight. Volume comes way down. And as it breaks out, you see the volume come in, you get the 1-2, and that's where you're buying it. Coming right, I was buying it right there. Let's look at another one. This is Nightbridge Tankers. I actually thought this was a stock that we looked at before, once again, because it looks so similar. Same characteristics, 44% in just 12 days. All right, so now you can get multiple pivots. All right, you might get multiple buy points. And sometimes what I'll do is I'll actually start my position. I start with a smaller position. This is a popular question, is how do you add to a stock and pyramid in a name? So a lot of times what I'll do is I'll buy the stock, and then within the base, it will actually form another pivot, and it will either tighten up even more or just elongate the base, where it really starts to have some nice symmetry, and the stock improves. It actually looks even better. And then I'll add to my position, or maybe I missed it on this one. I didn't buy it for whatever reason. And then I start watching it, and it tightens up, and it gives me that next buy point. You're going to see same thing. You're going to get the same 1-2 and the same type of setup within that larger base. Now, let me explain to you. There's like I said, there's going to be a few buy points. And within this contraction, you're going to get not just one contraction all the time where you can buy from. You're going to get multiple buy points sometimes. And I'm going to break this down. We're going to kind of go backwards from the buy point on the right side, and then and I'll just give you a quick history on this. I started off buying stocks coming out of these bases, and most of the time they were going into new high ground, and I was buying them off of cup with handle patterns, typical O'Neill type trades coming out of big cup with handles. And I started to notice that there was another little handle that was forming, and what looked like a buy point within the base, sometimes earlier and a little lower than the handle. And I had a sort of a rule to just stay in the upper third of the base, and I was buying when you were in the upper third, breaking out into new highs. But I noticed in the middle third there was this little confluence area that appeared to be a nice little buy point. So I started buying it, and it was a friend of mine. We used to talk all the time on the phone. He was a trader, and he would call me up and say, "Hey, did you see Cirrus Logic and it's starting to set up?" And I'd say, "Yeah, actually, I already bought it. I cheated." So we started calling it a cheat area. Later on, we called it the cup completion cheat, meaning that the cup portion of the cup with handle had completed, but you didn't get the handle. You got this cheat area. So that started to be a buy point that I looked for first. And then if I got it, I'd get in there, and I'd be in a little bit earlier, and I might even get a second buy point to add to. But sometimes you didn't even get the second buy point. And sometimes you don't get the cheat, you just get the handle. So what it did was it allowed me another opportunity to get on board a potential big winning stock. It gave me sort of another floor to get on the elevator to go from, say, we're not trying to get in on the low, but now I'm getting in at floor number 2 or 3, when before I was getting in on 5 to ride to the 20th floor. Now I'm getting in on the 3rd, and I might even be able to get in on on the fourth or fifth floor. So this was a stock that I did not buy off of this cheat area, but I did buy it right here when it got really, really tight. And as it came out here, as a matter of fact, this was the very first stock I started blogging. Someone, this is going way back 2010 when I don't think I was even on Twitter yet. I just started blogging. And this was the very first stock that I mentioned on my blog. I had bought it and I had said, I think it was the same day or the next day, I had blogged that I bought Cirrus Logic, at this price and the reasons why. Here's another one where you get the cheat area here, and then you get a second buy point. You get the little handle area. So again, prior to me recognizing the cheat area, I'd just be waiting for the full cup with handle. Now, take a look at Microsoft here. You can look at this on a weekly. Again, this is going to be the same on a weekly chart. You can look at intraday charts. It doesn't know any time frame. You're going to see these same things. They're going to work on various time frames, but I'm always using the daily chart. I'm using a daily, and then I look at the weekly, and I want to see both of them look constructive. So here's coming off of the bear market in 1990, and the low was in October, and you can see you set up what we call a 3C. Call this a 3C cup completion cheat. 3Cs. The cheat, or I just call it the cheat, coming off the cheat, and then it sets up the handle. If you remember, I think we talked about this earlier back in 1990. Dave, you said you went into Bill's office and you said there's all these cup with handles setting up, and they put it on the front page of the paper. It said cup with handles proliferate. We talked about this earlier. This was one of them, right?
Right. Yeah.
Let's see here. Okay, so now more characteristics. We're going to work backwards here. Now we're going to go from, we talked about we started with the uptrend, then we talked about the base, and then we got into the pivot point on the right side. We're going to actually go backwards a bit now and start to look within the base, and what are some of the characteristics that we want to see, and some of the tip-offs that this stock may be under accumulation with institutions, and that it's a stock that we might want to consider, and also to start to ascertain and gauge the quality of the base. So when you finally see these bases and you're getting that tightness on the right side, you want to grade the base. You're looking at, after a while, you're going to know, wow, this is a pair of aces. I mean, this is like a hand that I got to push a lot of chips on. Or you're going to see another one. You're going to say, okay, this might be a pair of tens. It's not the greatest setup. It doesn't have all the characteristics, but it's good enough to play, and maybe you take a smaller position. So there's some of the things that you want to look for, and one of the keys is to look for institutional demand. And Dave, I want to talk about and have you talk about when when we shake out some of these lows and we come back through those lows and we're coming up that right side, why we want to see big demand coming up the right side.
Well, because you want to offset the selling that was going on the left side. And the shakeout is very important, because what you've just done is you've gone under a priced area, and that looks like that 2 months of price, price of pattern, and you come in and you drop below it. And so you usually shake out a lot of investors that bought at higher prices. But if you can come back up and through that, especially on big volume, that's telling you shook out weak holders, and now you've got some institutional demand coming back in, and that should set that stock off, for a really nice run.
Yeah, and you see this over and over. Take a look at right here in MGA. Look it up the right side. You shake out that low, and then you just come ripping back. One of the keys that you know that it was a shakeout, and you've wrung out, part of wringing out that towel. This is one of the twists within those several twists or the contractions, is coming off the lows after you undercut, that you come ripping back, and that shows that institutions are coming in there. They have an appetite. And now this isn't ready to buy here. You're not going to buy coming. You're not trying to time this. This is an observation. This is something that you want to see within the base. You're actually looking to buy higher than this, and waiting for it to build that right side. But these are some of the characteristics you're going to want to see, and you're going to see it in virtually every stock that makes a big move. You're going to see some type of previous institutional accumulation, some big demand. You can see right here, volume spike, comes up that right side, and then you start getting that right side development, and you start tightening up and setting up for that move. This is a stock, Elan, that I actually bought. This was coming off the bear market in 1990. And what caught my attention is it came ripping back right here. It started tightening up, and I was watching it right in here. And then over a couple of days, it got super, super tight. If you come down, you can see the volume came way down. This was in January 91. And as we talked about this before, as we went to war, right on, I think, January 15th it was, the market took off and stocks just started breaking out of bases all over the place. And this is one of them that came out and was a key leader coming out of this base in this next bull market in 1991. Sometimes you'll get this institutional accumulation will happen on the left side of the base, and it'll definitely be way too early. You won't want to buy the stock. This is where you can run up on earnings, or in this case, you had company issued guidance. The company raised guidance. This was the Cirrus Logic. So I was looking at it over here, but when I was looking at this stock setting up, I took mental note of the fact that right here you had a nice big move, right, on the guidance. And now the stock actually came in. There was a general market correction right here. So that's fine. But the stock was able to set up. And at that time, I hadn't bought the cheat area, but it actually had a little buy point here and then a buy point right here.
The other thing about seeing positive price action in the months before, I even look back years. I go to a monthly chart and I actually see if the stock has an ability to run at some point in its history. And that just gives you an indication that, hey, this might be a company that has the right management, that have the right products, that are innovating, yes, they had a move 3 years ago and it went up, 2 or 3 fold times. There's something within that company that can create this move again. And I love to see that and see the history of a stock.
Yeah, and I think it's important to point out again that we're looking for continuation patterns. We're looking for a continuation of an already existing trend. Some people find that strange, that we want to buy a stock that's already up 300 or 400%. Or in some cases, I bought stocks that are up tenfold, and then they went up 5-fold from there or 20-fold from there. So we're looking for a continuation because we want to see that institutions are already in the name, it's in an uptrend, and we've got that inertia. Let's take a look at another one here, AMSC. Like I said before, we're going to go back and look at some of the names that we already looked at. And maybe we looked at in the stage 2 uptrend. We looked at the bases. We may even looked at the fundamentals, and keep adding the information to show you all the things that we're looking at within this stock setup. So on this stock, again, if you were looking at this tightening up on the right side, you would look at this big move up this left side here. And now we consolidate, and now we're set up for a continuation there. And when that supply stops coming to market, and those short-term holders that are in this volatility are weeded out, you've got some big institutional sponsorship right here. So this stock, they could be coming back into the name, and that's exactly what happened. Let's see here. Here's some more recent setups. Here's Workday, of course, WDAY. Many of you know this. Look at the move off the lows. See the big volume? That's the first thing we want to see. Then we want to see the right side development get real tight. You got here you go. 1, 2, 3, 4, getting smaller and smaller, nice and tight in the right side, and then bang, breaks out, and now you're in the stock and you can enjoy that move. Take a look here. Central Garden and Pet, CENT. This is one nice big setup here. I mean, again, this looks like this could be so many of the other stocks we looked at. Almost identical. This right side is amazing on how it looks like so many of the previous stocks.
Yeah.
Go ahead.
On this example and the previous example, what's interesting too is that both of them pulled back. I mean, you see, this went to 1972 and pulled back almost to exactly to where the buy point was right near where your arrow. But yeah, if you look at that pullback after the breakout, move farther over. Yeah, you're right there. Yes. Same. This happened with the previous example too. Sometimes if you miss that breakout, you can buy it as it pulls back, and you can be fairly confident, especially if the stock went out on big volume, because you got that huge base under you. And so it's actually a low risk buy point when it pulls back down there, especially if it's pulling back on the light volume.
And remember, we talked about 96% of big winning stocks, leaders, come out of market corrections. Look at right here. This is the S&P 500. You see, you're in a big consolidation here, very similar to what you would see right now in the Russell 2000, where you've got that base that's been for 9-10 months now. So again, here's a stock coming out, and it's coming out just as you come up the right side, and the market hasn't even broken out yet. It's still in this long, wide, this long consolidation here, and hasn't even broken out of that basing, but this stock is coming out because it's a leader, and the leaders lead. Let's look at another one here. So this is one that, again, you see the demand here off the lows. Sometimes you'll see, if the base is large enough, you'll see a bunch of points where you get this demand coming up the right side. You get a nice run right here, right up, but you're waiting for it to get nice and tight. Now, again, you draw that line across, you can see we've actually moved above there a little bit here, right here, but you never tightened up. You got to wait for that tightening. That's the key, is to wait for that tightening, buy from that tight point. Sometimes we call it a high pivot or a high handle. You might get that tightening will happen right above the price action. And it's right here. You can see just a little bit above it. And now look how it comes out, and wham, how it takes right off. See, again, as it goes through all those contractions, just like the towel getting tightened and the water coming out, here's a whole bunch of water, little less, almost nothing now. Now, boom, it's ready to go.
Yeah, and Mark, I just to repeat almost what you said on that, your second arrow, the reason why you wouldn't buy there as it came up above the black line is because it was coming straight off the bottom. It had no tightness to it. And anytime a stock comes from the lows all the way to highs, I mean, that's a 10-point move. That's almost a 25% move from 44.57 to 54. That it has to rest as it gets to new high ground. And it tried to tighten up there for a few days, but it didn't make it. It came back in. And that third arrow is exactly where your proper buy point is.
And this is where volatility contraction comes in, where I came up with this because I was teaching other people on how to analyze charts. And I found that so many people were misinterpreting the charts and misinterpreting O'Neill's work and the cup with handle and these various price patterns. So again, on this right side here, this is too wide, and it's just shooting right off the lows here. You don't have that tightness. So to be able to illustrate this is where I came up with the volatility contraction concept. And fortunately, it's really taken off, and it's really helped a lot of traders better understand this. And the key is that you really want to wait for that tightness on the right side and go through those iterations of tightening. Now, you may have where in this particular case right here, this would be one right here, one decline, and then you move up and you tighten up right away. This would just be a 2. 1 and then 2. So sometimes you can get just a couple of one contraction, but 1 decline, 1 contraction, and that would be a 2T, like I said, or 2C. And then you come out from there. We'll show you that on a weekly.
And I think that those 2 arrows, or the first arrow, is important. There's that shakeout again, below trading of about 4 months, and then it quickly comes out. And almost breaks out, but then tightens up again. But that shakeout is, I think, important to mention.
Yeah, and you can see that right here on the weekly. Can I even zoom up on this? Let's see if I can. Yeah, so you can see the weekly how it undercuts the low, and on the weekly it closes right at the high. And the very next week it moves up, closes right at the high, and then look how tight. Look at those weekly bars. See how tight it gets, and then bang, it comes out. So even on the weekly chart, you're going to see. So you should always consult a weekly too. Dave, I always look at a weekly. I look at a daily and I look at the weekly. Are you always looking at the weekly as well as the daily?
Oh yeah, I mean when I do more work into a stock, I look at it from daily, monthly, weekly, and then I even go down into 60-minute charts or 10-minute charts to absolutely time the exact spot of where I want to get in.
And that's overlapping time frames. What Dave's
Yep.
talking about is actually what we call stacking time frames. So if you go and you take a look, it's in a long-term uptrend. The current chart looks great on the daily. You look at the weekly looks great. You can even go down and look for these patterns, and you'll sometimes find in that intraday, like I showed you that intraday, where in that little bit of time frame there was actually a VCP. If you want to time it right down to the hour, to the minute, sometimes you'll actually get a setup intraday that will then correspond with the breakout on the daily. But you're going to start from the larger time frames and work your way all the way down to get to that very specific moment of buying. Now, I'm just going to back up here to page 180 again, and then I'm going to flip back to page 182 and just take a look how similar the characteristics are. May not be exact, but very similar. How you drift off and take out these lows a few times, and then come right up the right side and tighten before you explode. Let's go back to 180 again. You see, you drift down, take out the low, come ripping back, tighten up before you explode. Same exact characteristic, just a little bit different fingerprint, of course, but same characteristics. Here's Kenneth Cole. We've looked at this before, but you'll see you've got the move up the right side here, up the right side here, and then it tightens up right down to just a couple days. And again, look at the volume on that one day, comes way, way down, and then the volume comes in at the breakout. Look at the weekly. You see it, and I'm going to zoom up again. Let's take a look here. You can see on the weekly, you go through the same iterations. You got the nice weekly bar here, right here, and then it tightens up. You're going to see the same thing on the weekly. Okay, so now I told you I would talk about a little more and explain a little more on the cheat area and what we call the turn. I mentioned the turn earlier, so I got to get you up to speed. Sometimes I'll say something I haven't yet explained it fully. So let's explain the turn, or what is the official change in trend. So sometimes you get through a pivot, but you haven't officially, what I call, made the turn and gotten back into a new uptrend. So what happens is you're in a stage 2 uptrend, right? And now the stock corrects. So you now go into a short or intermediate term downtrend within the longer term uptrend. What you're waiting for and what you don't want to buy until that intermediate and short term trend now turns up, and you've got the long term trend and the current chart pattern all in the same direction. So the earliest that you want to buy is when you get back into an official uptrend on the current chart pattern. So now, very simply, the way to do this is you look for a break of the downtrend. All right, and I'm going to show you examples in just a second. You break the downtrend, then you pull back, and then the high of that pullback is what, and that's a pivot in itself. And depending on how deep that this pullback is, if it's shallow enough and there's enough symmetry, well, then this would be a buy point. But this is what we call the turn. And this just simply means that the stock, once it takes out that high, it's now made higher lows, and it's taken out this high, and now the trend is now up on the current chart pattern, and now you've got all the trends in your direction. Now, the thing you got to be careful of is that this doesn't happen too quickly up the right side, and you get what we call time compression. Time compression is simply where the stock chart hasn't been allowed enough time to go through the natural dynamics of supply demand of stock changing hands, or that towel squeezing. You haven't let the towel wring out all the water. So you don't want to buy the stock or the towel, if you will, when there's still a bunch of water in it, because now you've got still a lot of supply, and the stock can't take off and make a big move, or the probability is a lot lower because you've got this supply that will hold it back. You've got the trapped buyers, you've got the profit takers. That has not gone through the natural dynamics to be able to weed those short-term holders out, to now let the longer-term players come in and explode the stock when there's very little supply. So now you got to let that right side build. Let me show you how that looks. So, and Dave just said this before with, I forget what page it's on, but the stock that ran up the right side, he said that that's not ready there because it ran right up the right side. Here's a perfect example where you run right up the right side here. And even though this comes back and maybe this looks like, it's contracting, it's still, this is a compressed right side. It hasn't had the time to go through. And you see here, you start going through and now you're getting more and more tightenings. And Dave, this might be a time also to talk about fractals, because these tightenings really, are sort of a lesson in fractals, right?
Yeah, well, a fractal is a pattern within a pattern. And what you might see is you see a cup and handle forming on the daily. And you can even take that down. You might see a cup and handle within the handle if you take it down to a 30-minute or a 15 or a 10-minute chart. So sometimes you see that, and I mean, you can kind of on the right side here, it's really a cup and handle, but then you have another little cup and handle at points 3 and 4. You have one there, and so it's really a pattern within a pattern, and that seems to show up many, many times.
Yeah, and you have right here. What's right here? That's a cheat area, right? And then my little drawing tool here, and then you set up right here, and you got another pivot point. So you've got a buy point here, and you got a buy point here. And now if we draw this line all the way across, you see there's very little supply. There's very little trading that occurred above that price, but you do get that lower buy point there. And again, we're going to go into this more and more and more and deeper and deeper and deeper. So don't panic here. You may not be, you might be saying, what is he talking about there? What's he drawing all these lines? Don't worry, we'll get you there. So again, here, take a look at Troy Group. This stock just exploded 146% in 14 days. A great model of a super performance stock. See here where it comes and it runs right up real quick, and it's a little volatile here. See, it just hasn't put in the time yet. So now I wouldn't be considering this stock just yet. This just isn't ready. This doesn't, as Dave said, this doesn't have the look, right? But now it goes through more iterations, and now another, and you have that little pattern within the pattern. Like Dave just said, there's a little cup with handle here within the larger cup with handle. And you see, and now you're really tightening up, and you've got some symmetry, and all the elements are coming together now, and now the line of least resistance is forming. And that's why the stock, see, in all this time, the stock never comes out and explodes out. But notice how when you finally get the full right side development, and you get of all the characteristics come together right to that specific point, bang, it comes right out and it takes off with such efficiency. And this is, people wonder how I've racked up, huge returns over the years. And with the low drawdowns, it's timing. It's timing. You notice how when you get it right here and these stocks come out perfectly, there's little downside. You're at a profit right away. The stock is off to the races, and I'm selling, even into this first move, I might be selling some of my position, and then I'm cushioning my downside. So I'm getting my cake and eating it too. I'm getting that big move, and then I can take some of my profit, and I can now backstop my gain, and I'm free rolling the trade. We'll talk about that in risk management and position management later on. Go ahead, Dave.
One thing I'd like to point out too is that where you say too early compressed right side, the stock might have some of the characteristics, and maybe it had the earnings, but the pattern hadn't set up yet. Sometimes it's such a shame where you're looking at a stock and maybe you bought it where it said too early compressed right side. Maybe you bought it and then you took a loss on it and you said, I don't want to pay any more attention to this. And then you forget about it, and 2 months later, the thing breaks out and has this huge move. That's why you should have a list, and on MarketSmith, you can create all sorts of lists, and you check them every week, and to see if it's setting up again. Because, boy, if you had been on the stock too early and then forgot about it, look at the move that you would have missed.
Yeah, actually, Dave and I both, we keep a list of stocks that we sold and stocks that we got stopped out of. We actually keep a list on our screen, and we look at that periodically, or I look at it pretty much every day. I look at the recent stocks that knocked me out and see if they've reset, or because sometimes they have all the characteristics. And this is something that I call stock right, not price ready. You can have a stock that's the right stock, but it's not price ready. Price ready is when you're going to buy it at that point where, like I said, the right price, not the lowest price. You want the right price. You want the right stock, but sometimes it's better to have a stock that's not a great company, that's price ready. It takes off, it makes a big move. And meanwhile, some quality company that is a great company, but it never sets up, it never gets into the stage 2 uptrend, it never sets up the pivot point properly. It's too volatile and it knocks you around, and you can't ever make any money in it. So real important is price ready, as Dave is alluding to here. So again, we looked at this MGA before, and you see correct buy point is on the right side right here. See, that's the right price, right? Not the lowest price. That's the right price. And we don't know, you could say, well, like, what if I bought it down here? Well, that's great if we had a crystal ball, but we don't know that this stock is going to take off up this right side. And we don't even know if it's going to set up. So we've got to wait. We've got to wait to make sure that all these elements come together and we get that low risk entry point. Here again, 140% in 3 months. This is what you're looking for, and if you're going to look, even if you're going to hold for a bigger move, it would be nice to be up 140% in the first 3 months, right? That really gives you a lot of options. I mean, you can sell some, you can backstop, there's all kinds of things you can do once you're up 140%. You have a lot of options because you're nowhere near the loss column at that point. So you want to allow right side. You always want to allow right side development. I'm never buying a stock unless the right side is developed, and I'm getting that pivot point. I'm going through those contractions. I have that volatility contraction, and then that's the earliest that I'm going to buy it, is when you come and you get that change in trend, and then the pullback, and then breaking above the pullback high. That's when the stock is now in a new uptrend on the intermediate term level and the short term basis, in already a stage 2 uptrend. Let's take a look here go back again to Cirrus Logic. So let's say we didn't have the benefit of looking at the handle phase and seeing the cheat, right? Well, this is what we would see before we get to the handle. Remember, the cheat has to come before the handle. You're watching these stocks in real time. So before you ever get to that, you don't know if this is just going to come ripping out and not form a handle. So you're going to be entertaining that right here, and as it comes through the cheat area. So again, you draw a line through here. Yeah, you've got a little bit of supply on the left side, but not much. It's only trades there for a few days, and the decline is not that great. See, here's the other thing about I want to back up just a minute and talk about overhead supply again. So some people say, well, why would I buy that? Because there's overhead supply. Okay, well, if the decline was 60% and there was all this trading and it went down for 3-4 months, and now you're forming a cheat down there, that's no good. That's why Dave said we stay away from those stocks that are down 50-60%, because now you have to go through all those trapped buyers, and now that profit taking up the right side, and you've got all that overhead supply. This stock only came down just a little bit. If it comes down 10, 20, 30%, that's fine. And again, depending on how far away the supply is. If there was a lot of supply, you'd now have to have a big base to clear out that supply and move way over to that right side. On a shallower base, you don't have to have so much time, because you're going to clear it out, because you don't have you don't have as many trap buyers, and there's not as big profits coming off the low. All right, let's move forward and take a look. So here's the cheat. There's your cup completion cheat. So we buy here. All right, maybe we buy part of the position, and now we can pyramid up, or we buy the whole position. Now we go through this pullback, and it should have never stopped you out. It hasn't even barely gone below the purchase price, and it sets up even better. This is even a better looking stock chart now at a higher price. Okay. At a higher price, it's a better looking stock chart. So now you get another buy point. So this is the 3C, right? Cup completion sheet. This would be the handle phase. Both of them, very important, both had VCP characteristics, right? This came down one, you get, that's a 2, right? So now you come back up here and now you go through a couple iterations and maybe you could serve 2, 3, 4. But again, all within the base. Another thing that a key point is that we're not buying once it comes out of the base. That's it. We're trying to come up with as many buy points as we can within the base structure to be able to have all those opportunities, because we don't want to buy it. Once it goes up, it starts getting extended. Now that volatility comes in. We're buying from very low volatility buy points because that's where we get that low risk entry. Once the stock breaks out, Dave, once the stock breaks out of a base, you're not chasing it up. You're not buying it once it's going. No. Some people think, this pyramiding means that the stock goes up 10%, you buy more because it's going up. That's not what that means, right, Dave?
Yeah, no, you want to time it as closely as possible to right when the stock is moving out. Once it gets, I would say it used to be 10%, but once it gets 5% from that buy point, you have to stop. You have to stop buying. You can buy again only when it goes up and it forms another VCP. So you can add to it, but not, you don't want to get the position too big right at the beginning. You have to have some money management techniques and let it go once it's broken out.
I almost never buy more than 1 to 2% above the buy point. I try to keep it to 1. Occasionally I go to 2, but I'm never buying it up 3, 4, 5% above the buy point. If I either buy it right at the buy point, or if it takes off, I leave it alone. Sometimes they move too fast and you can't get them. So you let them go, and you got to get rid of that fear of missing out and just look for the next one. So here's Baidu. All right, everybody knows Baidu, right? So again, you got a cheat right here, right? It came out and then it made what? The turn, right? So once it breaks that downtrend, marks up, pulls back, when it gets above that high, that means that the stock is now, and I'll get a little drawing tool here, it's now in a new uptrend. You see, this is the downtrend, broke the downtrend, and now as you mark up, the break of the downtrend is not a new uptrend. It has to first pull back and then turn up and take out the high of that pullback. That's the key. And that is what I call the turn. Again, a lot of this vernacular, things that I'm saying, you're not going to hear anywhere else. These are my term. This is my terminology. At one time, a lot of this terminology nobody used. But since I wrote books and I've done seminars, you can go on YouTube and there's all kinds of videos on a lot of this. But still, I haven't heard too many people talk about the turn. That's one thing that hasn't caught on as much. But again, the turn is simply getting it back into an uptrend. Now you get the handle, and now you've got another buy point to either add, or if you missed the cheat, or maybe you weren't so confident at this particular time, and now you're buying, you can buy it here. All right, then it moves up, and now you're going to leave it alone. Okay, another one. Let's take a look here. Microsoft. And now here's another thing too. Here's another caveat, if you will, or a tip. The larger the companies, when you get to the really large companies, I like to look for cheats even more than the small caps. You could let set up right at the highs and wait for full development, because they're not followed by very many people. There's not many analysts following them. Most people don't know them. So they're still very inefficiently priced. But when you get into the big companies, like nowadays, the Amazons, the Googles, by the time they get to new highs, you got a lot of eyes on a lot of retail money, and you get a lot of noise. That wringing out of the towel and getting all that volume out, sometimes it's hard to do with a name that has a lot of sponsorship, many, sometimes thousands of institutions in it, and all types of retail trading. I try to look for, especially coming out of a bear market, I look real carefully for these cheat areas in the bigger names. Microsoft was a perfect one that was coming out right here. I actually bought it right here. It came through this level right here. And you can see again, there's where you draw your line, and you can see it comes through that pivot point, and then it forms a classic handle. And this is just a big cup with handle with a previous cheat buy point. Again, looking at Zillow. So Zillow set up perfect with a 3C. And you see, you don't really get a handle. I mean, you can call this a handle, whatever you want to call them semantically. But we're just looking for buy points on the right side that are volatility contraction patterns. And this set up really nicely, nice and tight here. And you see how efficiently it comes out? Boom, right out. It was up in the first 25 days, up 68%, in 12 months, up 182%. That's the kind of stock that you're looking for. Let's look at another one. We looked at this before. This was Green Plains. Sometimes you'll get a cheat, and then you'll get a setup a little bit later. Sometimes, a base on a base where it's almost adjacent to it, and now you get a handle, and you get another buy point. I'm just going to show you, a bunch of examples here. Another one here tightens up real tight on the right side. 6 months, 98%, 100%. Now, you ever hear the commercials, wait, there's more? Well, there's more. There's actually even a lower buy point. So when I told you I first started and I started noticing the cheat area and that there was a lower buy point that was high probability it was working. I find, and I get a question all the time, what's the percentage of success from the cheat versus the handle? They're about the same. It depends on the market environment. Some markets, you do better from the cheats than the handles, but they're about the same. In my experience, I found that the cheat is actually even a little bit higher probability. But there's another area that I look to buy from, and it's called the low cheat. I call it the low cheat, and it's actually before the cheat. This becomes much more difficult to recognize correctly, and it also has a lower probability of success because now you've got a lot more supply. You're way low in the base, and you've got to be really careful with these if the base is really deep. The base is really deep and it doesn't have a lot of time. Then it can be used on short bases, but they can't be deep. But now the difference between these three buy points is where they set up within the base. So the low cheat is in the lower third, the cheat is in the middle third, and the handle is in the upper third. That's how I differentiate them. So if it's in the lower third, I consider it a low cheat. And middle now sometimes you get all three of these buys. You'll get all three buy points, and sometimes you only get one. Sometimes you get none. They literally just run up right off the lows, and you don't get any buy points. That's very rare, very, very rare. Usually, you get one of these three, or at least one or two. Now, another caveat, if you will, or another hint here is, I like to use these low cheats also on recent IPOs, particularly if they are big IPOs, big, either big cap or very, high profile, something like Google here. And sometimes what will happen is they'll come through the low cheat and they'll never even form a cheat or a handle. And you'll miss them if you don't use the low cheat. So taking a look at Google here, and of course, this went up over 600% in 40 months, but this went up a hell of a lot more. This is Google coming off of the IPO. So it goes IPO, and a lot of IPOs, Facebook was a complete flop in the beginning. LinkedIn took a long time, had a big decline, took a long time before it finally was viable and set up with a VCP. What will happen is very often you'll get these, they'll correct, and then you'll get these cheat areas or these low cheats, and they set up perfectly, and you'll see how one after the next looks so similar. So let's take a look at Google here. You get a nice little setup right here. You go inside, just very tight, and you break out right up the right side. No handle, no cheat, right? So let's take a look at this. Here's Google. Look at that move. You see, you never really got another chance to buy it. It just came off the low cheat, and that's it. It was gone. Take a look at Twitter. Very similar. I'm going to just flip back and forth from page 201 to 202, which is going between Google and Twitter. Those almost look like the exact same stock, right? If you look at right here, just the low cheat setup, look at that. Almost identical. And same thing, right up the right side, and you don't get the right side development. See, 77% in just 16 days, right out of there. Just if you time that right. Here's one just recently that I just saw, CFLT. This is a stock that came out almost identical too. Look how it sets up. It goes public up a little bit, corrects, sets up that low cheat, and then bang, right up that right side.
Yeah, and it seems like this happens a lot with very hyped IPOs too. That everybody gets excited about it, everybody knows it, and I would think professionals after a few days sell right into it, and it has to reset the whole, to actually even form its first base before it starts moving.
Yeah, and what Dave's talking about is many, like I said, the Facebook and some of these very, very hyped up, well expected IPOs that every retail person has to own. These trades, these setups, they very often they fail first, and they go through big corrections, and they take a long time. Sometimes you get them right away where they set up these cheats, and sometimes they take years. LinkedIn, I think we have an example of LinkedIn later, but LinkedIn took years before it was able to set up. Some of them happen very quickly, and you get nice quick trades. But Room, for instance, VRM, this is relatively recently. It went up in just 8 days. It went up 40% from this little cheat area. But then again, after that, it wasn't much more in the tank, and it since then it's just horrible. So sometimes you get these quick trades out of them. Here's another one where ICPT, this comes out here. Now you see again, you get this low cheat right here. But it's all part of a much larger base. You have a perfect VCP right here. This buy point is great. This stock went up in just 25 days, almost 60%, but you got those two buy points. Let me show you another one. So also, this would probably qualify. Let's qualify as a cheat. I think, Matt, probably not a low cheat, but this just tightening on the right side here. Just going to show you a few more examples. TLRY, of course, is Tilray. Some of you might remember this. This was a little while back, but this stock came off of this. It was a little bit of volatility on this right side here, but it was real tight. Had that same classic low cheat setup after an IPO. Very similar. If you would have flash back to Twitter, Google, it looks so similar. This stock went up 1,000% in 28 days. So this is the power of timing these things properly. All right, now I'm going to tell you another little caveat here. Some of these low cheats that you'll see, some of them that I'll show you, or that you'll end up recognizing on your own. When you get the low cheat, it's so low in the base that sometimes it will be below the 50-day moving average. And then I've gotten emails and people have asked me, hey, you said, in your trend template that you're above the 50-day moving average. Now you're buying this low cheat below the 50-day. Okay, so with a low cheat, I will allow the stock to be up to 8% below a 50-day. All right. And again, this is why the probability comes down on it. The probability is a little less on a low cheat, and they're harder to they're harder to trade. The other thing, another little caveat that you have to be aware of, if even if it's below the 50-day, what I'm looking at is the angle of the 50-day. So if it's below the 50-day and the 50-day is in a very steep downtrend, and breaking out of the low cheat brings it right into that downtrending 50-day, that's one that I usually avoid. So sometimes you can have it be in a slight downtrend, but it should be close to being ready to flatten out or turning up. If you're in a real steep downtrend, it lowers the probability quite a bit. The low cheat, like I said, is really what I call an expert buy. As you start going down the base and getting closer to the lows, you have to learn more how to really ascertain overhead supply, moving average trend, or the angle or the momentum behind the trend, and really get it right. So as you move up and you get into the handle, now you're going to be above all those moving averages. All the trend is going to be all in your favor, and you're going to have all the time frames in your favor. But again, this is something that you're going to want to, you're definitely going to want to learn here. This was a high max, of course, and you see right here the low cheat, and then you set up the little pivot, and then you actually set up a low cheat, a cheat, and then a handle, and you can see a little pattern within the pattern right there.
Right. And I would add to that in that, especially if you're just starting out, and a lot of this is new, I would concentrate on just the the regular breakout point and the cheat. And you want to be as closer to the high as you can. After you've done well in those, then you can start looking for some of these lower cheats. But I would say, especially with little experience, concentrate on being higher in the pattern, closer to the high than the lows there.
I would agree 100%. And also, you should really focus on one setup. And once you can get that and you can be profitable under a very tight set of parameters, then you start expanding. But you want to have all this knowledge to know how it all ties together and the chronology of it. And you want to work backwards, look for full setups, and then you'll start to see within those setups if there's an earlier spot that you could have bought. Let's do that right now. So taking what you've learned so far, is this a stock that looks like you should be buying here? Is this a proper setup? Is it a cheat? Is it a low cheat? Is it a handle? Just take a look at this real quick here and make a mental note of that. And I'll give you the answer, of course. And the answer is yes, this is a stock that is set up really quite perfectly. As a matter of fact, I mean, this stock moves up 100% in just 14 days. Again, you see how it just rips right out of here? Again, that's price ready. And that's a stock that's price ready. And this is why you want to time these trades. There's people that say you can't time the market. That's the random walk hypothesis, and the market is efficient and it's impossible to time the market. If you're talking about the S&P 500, it's very hard. There's a lot of noise there, and it's very hard to time the S&P 500 or some of the big indexes. But when you're talking about individual stocks, and you start looking at even small mid-cap companies that aren't widely followed, there is tremendous inefficiencies in the pricing, especially when we talked about the big earnings. When you have the really big earnings and the big numbers behind them, it's impossible for the stock price to discount that and to look out far enough to really have all that information discounted in the price. So you get all kinds of opportunities. And yes, you can time your trades. I've been timing my trades for over 30 years now, successfully, after spending 4 or 5 and 6 years trying to time them unsuccessfully. But luckily, I always believed you could time your trades. Dave, you've been timing your trades for longer than me. Yeah. 40 some odd years, right?
Yeah, probably since 1982.
Yeah. And so that actually is the big, that's what really separates, me from, I think, someone else maybe that's not doing as well, is that I have that ability to time my trades. And it doesn't mean that they're all going to be right. I'm wrong half the time, but I'm managing my winners versus my losers, but they're all coming from these sets of characteristics and patterns that we're telling you. So with this one here, actually, it had a low cheat. It actually had an area where you could have bought even prior to the cheat. You had the low cheat. So you had 2 buy points that you could have bought here. And if you wanted to wait a little longer to get a little more confirmation, and you didn't, and you bypassed this first low cheat, you would have got that very nice cheat set up. Okay, so we covered a lot, and we're going to cover a lot more. This is just scratching the surface so far, right? We still have quite a bit more to go here, and when we come back, we're going to actually start talking about some of the things to look at after you buy the stock and the stock starts moving up out of these bases, how to then ascertain whether it's acting normal, it's acting abnormal, whether you should reduce your position and maybe even sell it before it hits a stop, and when it looks really great and you should hold it and maybe not even take a quick profit and go for a bigger profit because the stock is giving all the green lights, all the confirmations that you want to see. So that when we come back, we'll talk about that. And then we've got a lot more to go, lots of technical analysis, there's a lot more on looking at charts. We're going to get even more microscopic and more surgical. And then, of course, we're going to be talking about risk management, position management, selling, and all kinds of other fun stuff.
Mark, one thing I would just add and repeat this again is that study these examples, study this workbook, study these stocks that have the big moves, and look at them over and over and over again, so you get that picture in your mind of what a proper setup looks like, and you get that memorized in your mind. And sooner or later, you're going to be going through charts of today's market, and you're going to go, oh my gosh, this looks exactly like that pattern I studied in that master trader program. So just spend hours and hours, as much time as you can, to get that really honed.
Yeah, we're not giving you a 500-page workbook and going through all these examples to put on a dog and pony show. We're giving you this so you have a take-home manual and you have a model book to compare to, and to start getting yourself familiar with what you need to see for a proper setup and for a stock that you would be timing a buy on. And then you can start building your own models, and you start trading in real time and looking for stocks that look like this. That you're going to start off by basically looking for the stocks. And Dave, real quick, let's talk about finishing up here. I want you to talk about the counterfeit bill. Yeah, talk about that.
I was going to mention that. I guess this was probably years ago where the FBI, they would be looking for counterfeiters, $100 bills, $50 bills, or $20 bills. They would look for counterfeiters. But the way they would train these agents is they wouldn't show them the counterfeit bills that they had obtained in the past, but they had them study the perfect bill, the exact one that they were printing. They would have them study those, so they get that view in their mind of what a perfect $100 bill looks like. So then when they see a counterfeit bill, they're going to know, hey, there's something wrong with this. This does not look perfect. And that's the same thing you got to be doing with the market. You study the perfect examples that had the huge moves, and you'll see them sooner or later in the years to come.
It's one of the ways that I can identify people that are going to be successful with this, when just by the questions sometimes I get. We would do these master trader programs, and people will come up to me, and their question, they want to know what could go wrong, what does the stock, a bad stock look like, and what are all the ways that things, all the things that they shouldn't have, which is the exact opposite of how you want to approach this, because there's a million things that it shouldn't look like or it shouldn't do, but there's only a small handful of characteristics that you want it to have and to set up in this perfect way. So by trying to figure all the things that not to look at, you'll never figure that out, but you can figure out and know what that perfect bill is supposed to look like. And anything outside that is a counterfeit bill. So again, with these stock setups, anything that is outside of the parameters and these very strict and disciplined parameters that we're going to give you, anything outside that is off the table at that time. You're looking for that setup, those perfect characteristics, and that's what you're going to focus on. You get good at that, and you don't have to worry about much else. Everything else will take care of itself. So focus on getting good at the process and learning what these stocks are supposed to look like and the characteristics they're supposed to have, and you're gonna amaze yourself and how good you can be at this, and how much more effortlessly it's going to be when you finally put all this together. Okay, so we're going to take a break. This has been a pretty long session now, so I think we need a break now, and then we'll come back and move forward. Okay, talk to you guys in a little while.